Well, there's been a lot of talk lately about gold and silver, whether this pullback means the whole story is broken, whether the smart move is to wait for a cleaner entry, whether the people still buying physical metal are early or just plain wrong. So, in this video, we're going to separate signal from noise, and you're going to walk away feeling a lot sharper and a lot more confident about what may actually matter here. Today is Wednesday, April 15th in New York, so before we go any further, comment the day and date you're watching from. And if you value this kind of breakdown, subscribe and comment John A.G. Best, so I know you're here with me. Now, the heart of this conversation is not complicated, but it is uncomfortable. A lot of people assume that if they ever decide to make a serious move into physical gold or silver, the product will just be there. They assume the inventory will be sitting there, the dealer will lock it instantly, the website will work, the phone line will be open, the spread will be reasonable, and the process will feel about as smooth as ordering anything else online. That assumption may be a whole lot weaker than people think, because one of the most important takeaways in this market right now is that price and availability are not the same thing. They are related, sure, but they are not the same thing. A market can look liquid on a screen while being a whole lot tighter behind the scenes. And when people finally realize that difference, it usually happens all at once, not little by little. Here's what I mean. A serious buyer, not a casual browser, not some first-time caller with a tiny order, wanted to move a very large amount of savings into physical gold, not paper exposure, not, I'll buy the miners and call it close enough. Actual metal. And what he ran into was not the kind of flexibility he assumed he had. The message, in effect, was that the desired inventory was not just sitting there ready to go, and the trade would not be locked before full funds were in place. Now think about that for a second. The issue was not conviction. The issue was not even the quoted price in the abstract. The issue was execution, logistics, real-world access, the mechanics of turning intention into possession. That's a big deal, because a lot of people have built a strategy in their head around the idea that they can wait for the perfect setup. Silver runs, gold pauses, then they rotate. Or gold dips, the dollar softens, rates shift, then they pounce. Maybe they've even got the exact type of product in mind, the exact premium they'll tolerate, the exact ratio they want between one metal and the other. All very neat, all very orderly. But hidden inside that neat little plan is a giant assumption that can wreck the whole thing, and that assumption is that the market will still be easy to use at the exact moment you feel smartest. Maybe it will, maybe it won't, and that's where people get into trouble because they confuse being right about direction with being able to execute on demand. Those are not the same thing. You can be right about the big picture and still fail on the practical side because product is thin, dealers are cautious, replacement inventory is harder to line up, or everybody else suddenly has the same bright idea you do. That is a very different risk than most people are prepared for. Now, to be fair, this does not mean every shelf is empty right now. It does not mean the entire system is about to stop tomorrow morning. It does not mean every scary theory floating around online is true. And I want to be very clear about that because one mistake people make in this sector is jumping from supply can tighten quickly to therefore total collapse is guaranteed next week. That leap is lazy. Markets can stay strange for a long time. Systems can absorb pressure longer than seems logical. Price can mislead. Inventories can tighten without an immediate fireworks show. So no, this is not a cartoon version of panic. It is something subtler than that. It is the recognition that when a market is relatively small, specialized, and dependent on trust, financing, hedging, transport, fabrication, and replacement flows, it does not take a massive wave of public demand to make things feel awkward in a hurry. Sometimes it only takes a handful of very large buyers, and dealer behavior tells you a lot about that. When dealers become stricter about locking big orders, when they are less eager to carry oversized positions, when they want cleaner payment terms, that is not always some random policy choice. Sometimes it is the market itself telling you that carrying physical inventory has become a more dangerous game. From recent market updates, that risk backdrop is not imaginary. Gold demand in 2025, including over-the-counter activity, moved above 5,000 tons for the first time, while global gold ETF holdings saw one of their strongest years on record. Bar and coin demand also climbed to a multi-year high, even with prices making repeated all-time highs. In other words, high prices did not kill interest. They coexisted with very strong interest. That matters because a lot of the mainstream story still tries to reduce gold to one variable. Rates up, gold down. Rates down, gold up. End of story. Except it's not the end of the story, because official sector buying has stayed durable even as prices rose sharply, which tells you that some of the largest and most patient actors in the world are still willing to accumulate at levels that would have sounded absurd not that long ago. And silver has its own version of this. Based on recently published numbers, the silver market was already expected to remain in structural deficit, with industrial demand continuing to play a major role and above-ground inventories staying under pressure. More recent reporting says the market is now projected to enter yet another consecutive deficit year, with hundreds of millions of ounces already withdrawn from inventories over the past several years. That does not mean there is no silver out there. It means the cushion is not endless, and that distinction is everything. Now layer on top of that the price action we've seen this year. Gold ripped to levels above 5,000 earlier in the year before backing off, and silver made a spectacular move into triple digits before getting hit hard. So when people say, "See, the pullback proves it was all fake," I think that misses the more interesting possibility. Sometimes violent pullbacks do not end a move. Sometimes they flush leverage, force out tourists, and move metal from weak hands to stronger hands. Reuters reported that silver fell by roughly a third from its late January peak after a brutal washout, while gold also gave back a big chunk from its highs, yet current prices are still sitting at levels that would have seemed almost surreal before this run began. That's not normal behavior. And unusual behavior is exactly why execution risk matters so much here. Because when prices get jumpy, hedging gets more expensive, inventory gets more dangerous to warehouse, and broken customer commitments hurt more. Dealers are not just stacking metal in a back room with zero risk and whistling their way through the day. They are navigating financing costs, market volatility, and the possibility that a client who sounded very committed yesterday may suddenly disappear when the quote moves against him. That is not a tiny issue. A canceled large order at the wrong moment can sting badly. So when a dealer says, "We'll secure this after funds are in," that may be less about being difficult and more about protecting the firm from a risk environment that has become much less forgiving. And if the dealer is thinking that way, you should probably pay attention. Because the practical implication is simple. The market may be far less forgiving than your spreadsheet plan assumes. This is why I keep coming back to preparedness. Think about a storm. The smart move is not waiting until everybody else is standing in line for the same supplies, staring at half-empty shelves, getting mad that the system did not stay convenient. The smart move is handling most of your preparation while it still feels unnecessary, maybe a little early, maybe even uncomfortably early, but early enough that you still have options. That principle applies here, not because gold and silver are cans of soup, not because the world ends tomorrow, but because demand shocks in thin markets do not send a courtesy text before they arrive. They just show up. And once they show up, the conversation changes fast. Suddenly, people who said premiums were ridiculous stop caring about premiums. People who said they were waiting for one more dip stop caring about the dip. People who mocked physical ownership start asking which products are actually available. And by then, the best choices are often narrower, slower, or more expensive. That's the trap. Waiting feels smart, right up until it doesn't. Now, one place I do want to push back a little is this idea that every single physical move automatically means the whole exchange system is about to fail. That's too simplistic. COMEX delivery is a formal process tied to warrants, not a dramatic movie scene where bars are always being dragged out the vault door the moment a contract changes hands. CME's own delivery materials make clear that the process revolves around warrants, registered metal, and endorsed documents of title, with loadout happening only after additional steps. So yes, deliveries matter, but not every delivery headline means immediate disappearance of metal from a warehouse. Still, that does not weaken the bigger point. The bigger point is that physical behavior matters more than lazy headline narratives. If gold were truly finished, it would be odd to see record-level annual demand, massive ETF inflows, and continuing central bank accumulation. If silver were truly irrelevant, it would be odd to see recurring deficits, persistent stock drawdowns, and ongoing concern around available liquidity in major vaulting centers. That does not prove an overnight explosion. It does prove that the bearish one-liners are too shallow. So what do you do with all this? In my opinion, the wrong move is building your whole future around one heroic, perfectly timed transaction, one giant swap, one all-in order, one cinematic moment where the screen, the premium, the inventory, the dealer, and your emotions all line up in perfect harmony. That is not a plan. That is wishful thinking dressed up as precision. A stronger approach is layering, scaling, working in pieces, defining acceptable zones, knowing in advance what products matter to you and which ones are optional, reducing the burden on any single day to be the day. That makes you harder to trap. And it also helps with crowding, because the moment that feels safest to the public often becomes the moment the market is least pleasant to use. If enough people are waiting for the same confirmation, the confirmation itself can be the thing that causes the bottleneck. That irony catches people every cycle. If you're successful, share your success story in the comments so others can stay motivated. And let me ask you two things. First, are you more focused on getting the perfect quote or making sure the product you actually want is still obtainable when conviction hits? And second, if your preferred gold or silver item suddenly went to delayed or out of stock, would your current plan hold up or would it fall apart immediately? Those questions matter because access is part of the thesis, not all of it, but part of it. And one more thing before we wrap, because this is where people sometimes get the wrong impression. The case for physical metals is not that every buyer should expect instant riches. That mindset is usually what gets people chopped up. The stronger case is much simpler. For many people, a portion of gold or silver is not about getting rich fast. It is about holding part of your savings in a form that is not somebody else's liability. That distinction matters a lot more in unstable periods than people realize. It also helps explain why demand can hold up even when the chart looks messy. In India, seasonal and cultural buying still matter. In the institutional world, reserve diversification still matters. In the silver market, fabrication demand tied to electronics, grid spending, and broader industrial uses still matters, even with some areas seeing thrifting and temporary slowdowns. This is not a one-variable market. It is a layered market, which is exactly why simple headline explanations keep failing. And when a market is layered like that, patience has to be matched with preparation. Otherwise, patience becomes procrastination. Otherwise, discipline becomes hesitation. Otherwise, what sounds prudent on paper turns into regret in the real world. So no, I'm not rooting for some dramatic breakdown. A disorderly market helps almost nobody. What I'd much rather see is a repricing process that continues to expose how tight the physical side may be, without forcing ordinary people into a panic scramble. But whether that happens gently or violently, the practical lesson barely changes. Know your plan before emotion takes over. Know your dealer before urgency shows up. Know what you want before the crowd starts lunging at the same products. Because in markets like this, clarity is valuable, but readiness is priceless. That is really the whole game here. Not perfection, not prophecy, not trying to win the internet argument of the day. Just staying steady enough, early enough, and practical enough that if conditions tighten, you are not forced to improvise under pressure with everybody else. That alone can change outcomes. So yes, watch price, watch rates, watch the dollar, watch the headlines, but do not stare at the casino floor so hard that you miss what is happening in the back room. The deeper story may not be whether metals are having a perfect day on the screen. It may be whether the physical side remains easy to access once more people stop treating this like an abstract debate and start treating it like a savings decision. That is when things can tighten. That is when convenience can vanish. And that is why being a little early is usually far better than being 1 minute too late. Thanks for watching, and just remember, this is for education and perspective, not a personalized instruction sheet for your money. Your situation is your situation, so think clearly, do your own homework, and make decisions like an adult who plans ahead.